Okay, so here the authors are looking to explore the style premiums in the UK over the 82 to 2014 period. They also want to explore how these factors are affected in different regimes in the UK, for instance, in expansions and in recession markets. So up here in panel A, we have the small minus big, high minus low, up minus down factors, and this would be the size, value, and momentum. And so we see over the whole period that the momentum factor certainly dominates at 9.5%, excuse me, 0.95%, and this is per month. And shortly followed by the value factor and the small minus big factor. So this might tell us in a regression equation that if the difference between the possibly past 12-month return constituents exceed the constituents of the past negative return stocks, then our return of our portfolio would increase by 0.95%. Anyway, there's just some similar relationship for the high minus low and small minus big. But what the authors want to get at is splitting up the regimes where they did a Markov switching process between the expansions and recessions, and find that the momentum is similar whether you're in an expansion or a recession. Same thing for the value factor, which is about the same. But what we do find is that in expansions, the size factor becomes much more significant, and in a recession, it actually goes to the opposite sign. So larger companies do better in a recession than do the smaller companies and in the expansions. They also have over here coefficients of skewness, and we see that the value factor and the momentum factor are negatively skewed, which would mean most of the returns are negative with a few large ones, and the opposite for the small minus big, where most of the returns are slightly positive with a few big negative ones. So based on that analysis, the authors next wanted to understand, well, what are some of the macroeconomic variables that might explain these factor influences on the overall return of the portfolio. So here they have the macroeconomic variables. For instance, we have an alpha figure which would absorb any of the return that's not explained by any of the variables. But also we have the GDP growth rate, we have the inflation, the short-term interest rate, the term spread, the credit spread, and the change in the money supply. And then also we have here the small minus big, high minus low, up minus down. So for each of these different macroeconomic variables and a multiple regression on each of these factors, we can see which ones are where the macroeconomic variable significantly explains the returns of these factors. And since we have the asterisks out here, these would tell us which ones are significant. 3 asterisks is 1% level, 2 is 5% level, 1 is at the 10% level. So we can see for the small minus big that an increase in the GDP growth rate significantly increases the small minus big factor. Same thing for the inflation and changes in the money supply. This is at a 1% level, so that's a very big significance. And credit spread slightly at a 10% level. And then over here for the high minus low, the inflation rate, the short-term interest rate change is significantly related to the value factor as well as the credit spread. And then over here for the momentum, None of these macroeconomic variables seem to explain the momentum factor because none of these seem to be statistically significant. But also we see that the R squared is not very high down here, so that would tell us that this regression really, each of these factors really don't significantly explain the returns of these factors. But we can see that each of these factors does explain some piece of the factor returns other than the term spread. So next they dive even deeper into this, where we have the same factors and the same economic variables, but they've split them into different regimes. So we have the expansion regime and the recession regime to show the influence of each of the macroeconomic variables on the factor premiums in each of these regimes. So the first thing to look at here is the alpha figures. This would be all of the returns that aren't absorbed, or all the sources of returns not absorbed by these macroeconomic variables. So you could say that these are pure explanations of the size, value, or momentum premiums. So the first thing you might see is that they're all statistically significant except the size one in the expansion and the recession regimes. So as an example, since this is negative and this is negative, then this is small minus big, high minus low, you might say that an investor during a recession would be better off by owning large companies that have growth characteristics during a recession. And since this alpha coefficient is so much smaller than this one, then you wouldn't earn as much of a momentum premium during a recession, but it's at least still positive, where the past winners outperform the past losers. And so this result is somewhat in line with prior studies, specifically Fama and French, where they find that during recessions, small value companies are more than likely distressed and perform the worst. So you'd be better off owning large companies with growth characteristics during recession. So next, what's also interesting to see is that the macroeconomic variables as explanations of each of these factors become much more significant in a recession than an expansion. And we can see that from the asterisks here. We go from like a 10% significance in some of them to all of them having a 1% significance. So we can be almost assured that these variables are likely not zero. So to dig a little deeper into some analysis, it looks like the GDP growth rate significantly influences the size and value factors during an expansion. And so this will make sense if the economy is doing well and some more growth in the GDP rate occurs, then the small cap and value companies should do better than the large cap as they're more volatile. But during a recession, we have the same effect for the size, but value companies tend to have a significantly poor performance compared to growth companies during the recessions when the GDP growth rate increases. And the authors suggest that the reason for this switch might be that value companies tend to be in certain industries that usually don't turn around until the end of the economic cycle, such as utilities and such, which won't start having positive returns until the end of the recession. And for the inflation coefficient, we find that it significantly explains the small minus big premium, the size premium in both regimes. So this would say that if inflation increases, then the premium between small and big companies would increase as well. And the authors explain this as prior studies have found that smaller companies are it's easier to pass along price increases that might occur from inflation. So they'd be more profitable. So next we have the interest rates effect on each of the factors. And so for the size factor, you would expect that the smaller companies would have a tougher time managing changes or increases in interest rates because they're much more leveraged, maybe less access to capital. So investors would expect more of a return from these small companies to mitigate their risk than they would for large companies. So we see a large positive relationship between the increases in interest rates and the premium provided by small companies. And the same thing for value companies. Value companies are usually much more leveraged and much more leveraged, so investors would require a bigger premium than they would for growth companies. So we see there's a positive relationship. When interest rates increase, then investors would expect more of a return from value and small cap companies than they would from growth and large companies. And this value effect is present in both expansions and recessions, or excuse me, the interest rate effect on the value premium. And looking at the value or the momentum side, an increase in the interest rates hits the momentum premium pretty hard, so the past winners don't perform as well as the past losers in both regimes when the interest rates increase. And then looking at the term spread, this would basically just be the long-term interest rates less the short-term interest rates, risk-free. You can see from the size factor we have a negative relationship in expansions and a positive relationship during recessions. So the thought behind this negative relationship for small minus big would say that maybe small companies do not have as much collateral, and so as the credit market tightens here, they're not as able to get capital to participate in the expansion as well as the large cap companies are. However, we see a positive relationship between the term structure and high minus low, the value factor, which switches to negative during a recession. So authors argue in relation to past studies that this negative relationship for the value premium might be caused by the fact that growth companies don't pay as high a dividend as value companies. So when the term structure increases, other securities pay higher interest rates, but the growth companies don't pay dividends, so they return less than the value companies. So investors are requiring a higher return of the growth companies, which makes their returns exceed those of the value companies. And so related to the momentum factor, we see that the term structure negatively affects the momentum factor, where an increase in the yield curve might make the past losers perform better than the past winners. And the authors suggest that maybe that's because the past winners are typically higher beta or more volatile than the market or the past losers. So when the term structure increases, that would make the market go down. And so the more volatile securities, like the higher momentum securities, would perform poorly as the market goes down. So next we have the credit spread. The theory would be that, the credit spread is certainly identifies the risk of the credit markets and the tightening. So as the credit spread increases, we would expect investors to require higher premiums for the factors, and that's what we find here in both regimes. However, we do see that past losers outperform past winners when the credit spread increases. during an expansionary regime. Finally, looking at the change in the money supply as it affects each of the factors, looks like there's not a significant relationship to each of the factors in the expansionary regime. As we can see, there's no asterisk beside the coefficients here, but in the recession we have a significant relationship. At least when in the small minus big, an increase in the money supply increases the difference between small companies and large company returns. The opposite effect to value companies, large cap companies perform better than small cap companies when there's an increase to the money supply, and no effect on momentum. And so for the value factor, an increase to the money supply might signal to investors that there should be growth in the economy, so then growth companies perform better than the value companies. And they also suggest that the positive relationship for small cap companies and changes in the money supply might be due to investors still requiring a higher premium for small companies than large cap, because even though the money supply has increased, the small companies don't have as easy access to those funds, so they're still kind of crippled by the ongoing recession, whereas larger companies are better able to access that money supply. So the investors require a larger premium for the risk of owning the small companies than owning the large companies.